Very good afternoon to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountants of India, I welcome you all in today's webinar on various intricacies as well as the considerations while finalizing the Statutory Audit Report. As you all are aware that WSB has conducted various webinars as well as VCM on various topics on standards on auditing. And we have covered all the standards on auditing, then CARO, then Schedule 3, then all the line items of fixed assets, all the line items of balance sheet, like all the assets as well as liabilities, that is various considerations while auditing the assets and liabilities. And this is the apt time for the small and medium practitioners and very, very important for the finalization of the report. That's why we have chosen this topic to various practical consideration by finalizing the statutory audit report. And in order to cater this very technical topic, we are having with us C. Manish Sampatji, as well as our Honorable Central Council member and Chairman of Research Committee, C. Anuj Goyalji. So on behalf of WSP of ICI, I welcome you, Chairman sir. I welcome you, Manish sir.
Thank you.
And it is my proud privilege to share with you the brief profile of our Honorable Central Council member, C. Anuj Goyalji. C. Anuj Goyalji is the Central Council member of Institute. He has made significant contribution to the profession with his extraordinary tenure of 16 years in the Central Council, 3 years in the Regional Council, and 6 years in the branch, including Chairman of the Central Area Regional Council. He was the Chairman of various ICI Central Committees, member of the Editorial Board, and so on. He is currently the Chairman of Research Committee, the ICAI's oldest technical committee, as well as the Chairman of the Committee on Financial Market and Investors Protection, which organizes training programs, seminars, conferences, and certificate course on financial market investor protection and another related laws. He is also Vice Chairman of Peer Review Board. He has a vast reservoir of the knowledge that is supported by the various professional degrees, including CA, CS, CMA, LLB, MCOM, DISA, and DIRM. He is also the president of Reliable Group of Institutions, Ghaziabad, and director of Lions Club of Ghaziabad since 2005. So it is our proud privilege that we are having with us today our Honorable Central Council member, C. Anuj Goyalji, and I request Anujji for his keynote address. Over to you, sir.
Thank you, Anilji, and I'm really very happy that our committee WASB is so active, and we are trying our level best to see that how we can really do something very, very concrete, not only for the profession, but in turn for the nation. We are having our very, very prominent resource person, Manoj sir. I welcome Manojji on behalf of the Institute of Chartered Accountants of India.
Thank you.
Friends, we are having webinar. I'm pleased to note that our auditing and assurance standard board has been organizing n number of programs on a day-to-day basis for the benefit of the members, and I compliment WASB for its efforts to update the knowledge of the members on all the auditing standards, audits of various items of the financial statements and other auditing aspects. And friends, as we are very well aware that auditing standards on auditing are the most important thing for the practicing chartered accountants, for the auditors. Accounting standards are supposed to be taken care of by the auditee, and as an auditor we have to see that whether the accounting standards have been properly taken care of while preparing the financial statements. But as an auditor, when we are doing the audit, I think it is the most important thing which a auditor has to take care is that he has to undertake the audit as per the standards on auditing. So standards on auditing are very, very important. I think most important for the chartered accountants who are doing the test function. Friends, the topic of this webinar is very, very important, since audit report is the final outcome of audit engagements, and the auditor communicates the results of audit process through his audit report. So it is important that audit report is properly drafted by the auditor. We may have undertaken the audit in the best possible manner, but unless and until the audit report has been drafted in an appropriate manner, whole of the audit exercise becomes very ineffective. Friends, for finalizing audit report, auditors should consider the requirements of the standards on auditing, essays on auditor reporting. These includes the SA 700, forming an opinion and reporting on financial statements, SA 701, communicating key audit matters in the independent auditor's report, SA 705, modifications to the opinion in the independent auditor's report, SA 706, emphasis of matter paragraphs and other matter paragraphs in the independent auditor's report, SA 720, the auditor's responsibilities related to other information. So by finalizing audit report, auditor needs to consider very clean, unmodified report opinion is appropriate, or whether they need to issue modified opinion, that is qualified adverse or disclaimer of opinion. Friends, in case of modified audit report, auditors should give clear reason for making modification in the audit report. In the case of listed entities, auditors should include key audit matters section in audit report in accordance with the requirements of SA 701. And auditors should include other information section in audit report in accordance with the requirements of SA 720. If emphasis of matter para or other matter para is required in audit report, auditors should include such para in accordance with requirements of SA 706. Friends, auditors should bear in mind that emphasis of matter para or other matter para cannot be used as substitute for giving a key audit matter. In case of disclaimer of opinion, key audit matters section or other information section is not permitted in audit report unless it is required by law or regulation. So friends, in case of finalizing audit report of companies, auditors should also consider the requirement of CARO 2020, requirement of clause 1 of section 143.3 of Companies Act 2013, that is reporting on internal financial controls, requirements of other clauses of section 143.3 of Companies Act 2013. Friends, requirements of Rule 11 of the Companies Audit and Auditors Rules 2014 also should be taken into account. So I am quite confident that our guest speaker, Manish sir, who is very competent and very prominent professional, and he's having very vast experience in the field of attest function in the field of audit. I think he will be a better, best person to guide us and rather to teach us that how we should draft our audit report, because unless and until we will be having that we may have done the audit in the best possible manner, ultimately that will not be known, that can't be communicated to the outside world or to the regulator. So I once again welcome all of you, and of course I once again welcome Manish sir, and over to our honorable. I think before that I will request our MOC for the formal introduction of our honorable guest speaker, and then we will have the deliberation of Manish sir. Thank you very much.
Thank you, Anuj.
Thank you so much, sir. Thank you so much for your words of wisdom. You have covered a lot, as well as the gist, as well as the crux of this seminar, by how to cover these section SA 700, 701, 705, 706, and 720. And we have to include while finalizing the audit report, the CARO, as well as the internal financial control and various clauses also. You have covered and you have given all the guidelines for this, how to finalize the audit report, sir. Thank you so much, sir. Thank you so much for sparing your valuable time and acceding to our request on a very shorter notice. Thank you so much, sir. Thank you. And thank you, sir. Thank you. And it is my proud privilege to share with all of you the brief profile of our today's learned speaker, C. Manish Sampath also. Manish is a commerce graduate from Bombay University and a chartered accountant, and he is in practice since more than 26 years. He had joined CNK and Associates LLP as partner by merging his individual practice. He is a part of audit and assurance practice of CNK and specializes in attestation functions of various banks, foreign multinationals, and new age businesses in the service sector. He handles statutory audit of the several large banks, listed companies, foreign companies, large private companies, law firms, and charitable trusts. He has handled the audit of Reserve Bank of India during 2013 to 2016. He also has experience in valuation and due diligence. He has been a part of many study groups and subcommittees under the AASB, ASB, and other committees of the Institute of Chartered Accountant of India. He has contributed in the revision of guidance note on bank audit and part of the expert panel of address the queries of members regarding bank branch audit. He is also part of the various study groups formed by the Accounting Standard Board of ICAI for the upgradation of the existing accounting standards to bring them nearer to the Ind AS. Currently, he is also involved with developing the study material for the Center of Audit Quality initiated by ICAI. He also contributes the Financial Reporting Review Board of ICAI in CAQ, Sustainability Reporting Standard Board of ICAI. He is currently the chairman of Auditing and Accounting Committee and has been a past president of the Bombay Chartered Accountants Society. He has also compiled the publication Mandatory Accounting Standards from Published Accounts, jointly published by GCAS, NCCH, and frequently asked questions on the accounting standard. He was a faculty of HR College of Commerce and Economics for many of its professional courses and has given guest lectures in the management institutions too. He is honorary secretary of the Audit Committee of Cricket Club of India Limited, and he has also delivered lectures on various topics of professional interest, including accounting, auditing, corporate law, valuation, due diligence, practice management, and others. Since still list is very vast, and he has requested not to go for in detail. So thank you so much, sir. It was my proud privilege to share with all of you the brief profile of Manish ji. And if our honorable chairman, sir, permit, can we start the technical session, sir? Yes. Thank you so much, Manish sir. Thank you so much. Over to you. And may I request to you to please start your deliberation, sir. Over to Manish sir, please.
Thank you. First and foremost thing, a big thank you. It is an honor to come and address the members, and thank you to the AASB, to the Institute of Chartered Accountants. Also, thank you to Anuj ji and to the Master of Ceremony, Anil ji, to introduce me. I would say, the topic which the AASB has chosen is currently very apt, because audit of larger companies have got over by the month of April, May, and now it's the time where most challenging situations or challenging circumstances arise. Because for large companies, you have number of chartered accountants, number of finance professionals who are there. So there is, though the issues would be complex, but the reporting would take would be rather easy. These are the companies where September is where the private limited companies and the unlisted companies and the unorganized companies which come for audit for us. And it's a big challenge for us actually to, not only to do the audit, but to draft our audit report, also collect the evidence and form our opinion. So I think so it's a correct, appropriate time that in the month of September, we are having this. And actually, my work was a little bit lightened by Anuj ji, because what he gave a teaser of what I'm going to cover in the next 1.5 hours. He has covered in the first about 10 minutes. So he has given like an index of all items that I will be covering today. So with these words, I will start the discussion, or the topic today that has been given to me is the practical. In fact, the topic that was given to me on the audit report, and when Anil ji was in touch with me, he told me that we have covered all the balance sheet items, the P&L item. I said, ठीक है, अभी auditors ने सब items, सब areas cover कर लिया है, तो ultimately end में क्या होता है? What is the final product? The final product is naturally the audit report that we all give. So therefore, it is all the more important. Friends, more so, till recently, we had an audit report of 6 pages, 7 pages. Now, if you go to see, I was just finalizing an audit report yesterday of a private limited company that is 13-page audit report, and that also is not a listed company. And if you add, as was mentioned earlier on CAM, 3-4 pages would be added. So I was just seeing the audit report of Infosys, that is 16 pages. Then I was seeing an audit report of some other large company that was 19 pages. So it also depends, including the CARO, what are the contingent liabilities, etc., etc. So it's not a cut, copy, paste job that we used to do from last year. We used to copy the file from last year, just change the date and go ahead. No, friends, it's not that. We require a huge challenge. So what exactly has happened is that, in 2018, even these standards, the standards which were mentioned earlier, which are used for the audit report, the 700 series were revised in 2018. And now all the the auditing standards that we have are at par at international standards. So therefore, there is a requirement to make, bring about a consistency in reporting, that all auditors, the opinion that they are giving are consistent, are actually meaningful. So therefore, that is the main purpose for which the standards were revised. And if I will take you through my presentation. And what I have been particularly, I have kept in mind is, no doubt we will be covering the standards on auditing, but in between, that's why the name of the topic is practical challenges, the practical issues that come across. So I will be flipping, and I have got 2 or 3 audit reports ready in front of me. So in my presentation, I'll be flipping, and I'll take you through the law, I'll take you through the requirements, and then I will flipping and showing in the audit report also that in practical life, how it is reported, what is the issue. And while presentation also, from my limited experience with my interaction with clients, with my interaction with fellow professionals, with fellow chartered accountants, whatever queries we raise, if somebody has asked me any query, or I have come across such a situation in actual life, I will try to share it with you. So therefore, that will help beneficial. So with that words, I think so I will start my presentation. I will just give me a minute. I will share my presentation, and I will just require a confirmation if it can be seen by everyone. Is the presentation, can you see? Hello? Is my presentation?
Fine, sir. Fine, sir. Fine, sir. Fine.
Fine, no?
Fine.
Fine. So the topic for the day is statutory audit report. And as I told you, what I personally feel is that, and it was mentioned earlier also, that after doing all the hard work, after doing the, collecting all the evidences, after interacting with the client, after solving the queries, after resolving all the queries, getting all confirmations, collecting all evidences, then ultimately we have to, give our opinion on the financial statements as to whether they give a true and fair view or no. So therefore, the audit report itself is like a final product. It's a finished good for us. And friends, I believe that not only this audit report, besides whatever, negative publicity, wrong or right, whatever negative publicity that our profession is getting, I think so an audit report is actually it's a brand building exercise. Actually, it's a, chance that we get to showcase our competency, to showcase our services, how we, can deliver our services. So therefore, I think so it is important to do good work, but it is equally important for us not only to do good work but to show also that we are doing good and competent work. And that we can only do if that, improve the quality of our audit reports, improve the quality of the services that we give. So therefore, it becomes important. So with this, I think so I will start my presentation. Of course, this is just a presentation of, that these are my views and not necessarily the views of the institute or the firm. And this is the agenda for the day. Okay, now the institute standards on auditing and various implementation guides and the various material illustrative formats given by the Institute of Chartered Accountancy on audit report tells us how to report. But actually what to report comes from the provisions of the Companies Act. So I'll be like to spend about 5 to 10 minutes on the important provisions of the Companies Act, which talks about the powers and the duties of auditors from where we get. So therefore, again, to sum it up, what to report comes from the Companies Act, and I'll be, next few slides sharing what to report, and how to report on the various issues is given. Guidance comes from the standards on auditing and the various publications from the standards on auditing issued by our institute. Then also, along with this presentation, as I told you, I would like to make it more and more user-friendly and more practical. I have, shared certain FRRB observations on that audit report. What FRRB has found out that the common mistakes that we as auditors are making. So that I'll be covering. And though, being an, a professional in service, definitely, I like to deliver more than what I promised. So therefore, if time is there, then if time permits, a couple of minutes I would like to spend on, a special implementation guide that institute has come out with on reporting on certificates for special purpose, because I yet feel that some of our members are making the mistake and not complying. Yet the certificates that they are issuing is to whomsoever it may concern. This is to certify that we have checked this, blah blah blah, and all that. So that's not the correct way. So I think so. If time consumes, if time permits, I will cover that portion also. Now, coming to the Companies Act, of course, these are the most important chapter 10, that deals with the audit and the auditors. And what we will be doing today or covering today is section 143, which relates to only powers, duties of the auditor. Now, before that, of course, the Companies Act provision section, these are some important which I might refer to in between. So therefore, I'm just covering. Schedule 2 refers to the useful life and how to compute depreciation guidance is given. So therefore, Part A, Part B, and Part C gives that various guidance on the useful life of assets. We all know that earlier the Companies Act used to give percentage of depreciation, but that has been done away with. And now we have useful life, from which we derive the rate of depreciation. Then Schedule 3 recently was revised. A lot of additional disclosure requirements have come. So Schedule 3 gives the general instructions or the general format or the information to be disclosed in the financial statements, more particularly in the balance sheet and the statement of profit and loss account. Schedule 3 has got 3 divisions: Division 1, Division 2, and Division 3. Division 1 is applicable to companies to which Ind AS do not comply. So they come with the normal financial reporting framework, or the IGAP, that is called, the Accounting Standard Rules 2006. And financial statements which Ind AS is applicable are called companies Ind AS Rules 2015. So therefore, Division 2 applies to disclosure as part of that. And Division 3 is applicable to NBFC companies. And as I told you, a huge change amendment has happened in Schedule 3, which is going to be applicable for the first time for financial year March 22. So the March 22 audit that we cover would cover all these additional disclosures that we require. And we all know that we are already giving all these additional disclosures as far as ratios, etc., aging and all that is concerned. So I don't want to cover that. But of course, Section 143, what does it talk about? 143 has got 1 to 15 subsection, and this deal, it is equivalent to, the corresponding to Section 227, 228 that we have on the earlier Companies Act, and also 619 relating to government companies. So all these 3 sections have been, clubbed into one, which talks about powers, duties of the auditors, including, compliance with the standards on auditing. So that is summed up in 143. 143.2 talks about the auditor's duty to report. 143.3 is the most important aspect that we will be doing, and that has also got A to J subsections, wherein what the auditor's report should include is covered. So that is what I will be covering in detail. 143.11 talks about CARO. So we are not doing the session on CARO. So this will be just briefly dealt with. Subsection 12 and 30 deals with fraud reporting. Again, not the topic for today. So briefly, I will just mention that. And 14 and 15 deals with penalty, contraventions, etc. So I will not deal with that. So coming to 143.1, what does 143.1 says? 143.1 says that the auditor would have a right to access to the books of accounts at all given points of time, and he has a right to get information and explanation from the management on the matters that are relating to the audit. And 143.1 said that it is the duty of the auditor to report if any of these 6 items which I have jotted down over there is not complied with. So only if, so therefore this section says that only if these matters, if any of the answers are in the negative, then the audit report or the auditor has a responsibility to mention on this. So therefore, you will observe that whenever we draft our audit report, whenever we finalize our audit report, whenever we sign our audit report, unless and until any of these 6 questions are negative, we do not mention. So also you will find that the illustrative formats, even the 700 does not cover this, So therefore, usually this, even in my life, in my practical experience, I have not seen mostly people covering this. So these are just dealt with, if any personal expenses are there, or any actually some transactions have been shown represented by mere book entry, etc., etc. So therefore, these 6 points cover that. But more importantly, 143.2. What does 143.2 says? The 143.2 says that it is a responsibility of the auditor to report on the financial statements, and the financial statements are such financial statements that are presented at the AGM. So naturally, his auditor, his appointment of the auditor is at the AGM, is appointed by the members. So ultimate responsibility is to address the report to whom? So statutory audit report is always addressed to the members of the society, of the company. Which financial statements are adopted at every general meeting, and what does he has to report to in the financial statement? But before we go to the 5 matters that he has to report to, because this becomes important in our next 1.5 hours of discussion. Financial statements here, I don't want to get into what is the definition of financial statement, because it is very clearly laid down in the Companies Act that what are financial statements: balance sheet and statement of profit and loss for all companies, cash flows whenever they become applicable, and if the company is following Ind AS, then naturally you would have statement of changes in equity, etc., and the other notes and the significant accounting policies. So all these statements put together is called financial statements. And when I'm, in the next 1.5 hours in my discussion, whenever I refer to financial statements, I'll refer to all these statements. So first and foremost thing, it is the responsibility of the auditor to report whether the financial statements, first and foremost thing, are prepared in accordance with the provisions, all the provisions of the Act. Second thing, the management has prepared these financial statements by following all the applicable accounting standards. So as I told you, applicable accounting standards come from section 133 of the Companies Act. So whether the company follow the IGAAP or the non-Ind AS or the Ind AS financial statements. Then third most important thing, that he has been independent and he has complied with, of course, that does not come from the Companies Act, but he has done his audit by using the standards on auditing as prescribed. So for the first time in the Companies Act, standards on auditing are being part of the Companies Act. So section 143.3 also refers to the standards on auditing. Then any other matters that may be included under the Act or the rules made thereunder. So not only provisions of the Company Act, but any other matters, if under the Companies Act, if any other rules are included, then he has to report on that. And most importantly is that under the order under subsection 11 to 143. So this is government or the MCA or the Ministry of Corporate Affairs from time to time updates the matters that are required. So this year for the first time we are having CARO 2020. So that CARO 2020 gets notified under subsection 11 of 143.3. So therefore it is the responsibility of the auditor to report on the CARO points also. And what he has to report, report that according to the best and best of his information and knowledge, and as per the explanation and information provided to him, the financial statements give a true and fair view of the state of affairs of the company, and at the end of the financial year, and the cash flow, etc., and any other such matters as may be prescribed. So that is his responsibility. Now coming to 143.3. What does 143.3A stand as said? So therefore, friends, why I'm mentioning or spending some time on 143.3A is that you can easily correlate this 143.3 to any other regulatory matter. So when we go to our audit report, the format of our audit matter, whenever we see any other regulatory matters that we relate to, that is the format of the audit report that the institute has come out or in the illustrated format. It covers all these points one by one. So therefore, that covers that whether he has sought all the whether he has sought and obtained all the information and explanation that were required to the best of his knowledge, that were required for the purpose of his audit. And here the Companies Act says that if he is unable to do so, then he has to give the details why he has not been able to get that information, and the possible, if he can quantify, possible impact of such information on the financial statements. That is most important. Then whether in his opinion proper books of accounts have been maintained, which were as required by the company, or which were required under the provisions of the company law, whether those books of accounts has been maintained, and whether he has examined those books and accounts. This particular subsection B of 143.3 also says that, okay, if there is a branch, the company has got branches, and if you have not, the auditor has not visited the branches, whether the branch auditor has done his audit and whether he has sent his information, whether he has sent his return, and whether the auditor has looked through that returns, and whether that information is adequate for the purpose of his audit. So here the requirement also is there that if there is a big branch, particular branch where he's not the auditor and he has not got adequate information, he can go visit that branch and do the audit. Or if not adequate, then he can also make a appropriate disclosure in his audit report. Whether uh, the report, okay, now this also comes to that whether the report of the branch office which the company audited under subsection 8. So therefore, as I told you, that some branches might have branch auditors. So whether he has dealt with that audit report under subsection 8 conducted by other branch auditor, whether he has included and whether he has dealt in a proper manner. So that covers that. Then whether the company's balance sheet and the profit and loss account dealt in the report are in agreement with the books of accounts and return. Then whether in his opinion financial statements comply with the accounting standards, the applicable accounting standards, Ind AS or IGAP as the case may be. So these were all the requirements of the previous act also. Now there is an important, the last point on this particular slide is that the observations or comments of the auditor on financial transactions or matter which may have an adverse impact on the functioning of the company. So therefore, this is the requirement of the standards. And as and when we come to the guidance on SA 700, I will cover this, that if an auditor observes any, adverse remark or adverse comments or adverse transaction, which in his judgment are, which he feels that this might have an adverse impact on the functioning of the company, then specifically he has to report on that. So therefore, what has to be reported is mentioned here. How to report that is the standards on auditing that we get the guidance from. So therefore, friends, just to jump the gun a little bit, yeah, I would like to mention that suppose if there is a adverse qualification or an adverse impact or any other adverse comment that an auditor makes, he should bring the reference back to that paragraph over here. I will be doing that practically how it happens. I will be telling you, but just park this aside and remember this, that how this has to be reported. Then whether the director is disqualified from being appointed as a director under subsection 2 of 168. So this we know under certain circumstances, if the annual report is not filed, etc., then the auditor, the director becomes disqualified. So this he also has to mention. So this will be an additional check that an auditor has to do, that any of the directors are disqualified to be an director. Then again, most important and new thing, any qualification, reservation, or adverse remark relating to the maintenance of books and accounts and other matters connected thereof. So if he has any other reserves or any other qualification, then he has to again cross-reference that qualification over here. So he has to mention that. So therefore, by virtue of this, friends, now initially, the veterans or the, people from my generation might recollect that whenever there used to be a qualification in an audit report, always it used to be either highlighted or in italics or something like that. So now the requirement for italicsing it or highlighting has done away with, because you are specifically, the standards on auditing have become more, more in detail, and you are giving more information. So therefore, it is not required to highlight or to italics it and show it separately. Whether the company has adequate internal financial controls with reference to the financial statement. So here, then we all know that certain large types of companies which are referred to in clause 1 of subsection 3, clause I of subsection 3, 143, do not, so rather than that, internal financial controls are applicable to large companies other than other than the private companies, and even private companies of small size or 1% companies are exempt, or even the private companies whose turnover is less than 50 crores as per the latest financial system, and which has aggregate borrowing from banks, financial institution at any given point of time less than 20 But initially, when this draft Companies Act came out, it just mentioned on the adequate financial controls. But we are not competent enough, or it's not our responsibility to just report on financial controls. Institute immediately sprung into action and immediately came to our support, and immediately came to our help and assistance and made hue and cry and made representations to the Companies Act, and it was amended that yes, a statutory auditor's responsibility should only be restricted to reporting on adequacy of internal financial controls with respect to financial statements, whether they are in place during the year and whether they are operating efficiently or no. So therefore, this particular requirement also is there. Friends, here I would just like to pause for a minute and tell you that there were, two types of reportings were happening. I understand that this is a rather complex reporting requirement. So therefore, in larger companies where it is important and where actual work is happening and, auditor is taking a lot of responsibility, they give another annexure, that annexure to reporting on the adequacy of internal controls on financial statements, with reference to financial statements, whether they are operational and whether they are operating effectively or no. So there is a separate annexure, but also sometimes unlisted and some companies which are not in public interest entities, they give a small paragraph itself in this particular other regulatory requirements only, the opinion paragraph. So of course, more and more people are giving separate annexes, but I'm just telling you that even these small opinion paragraphs, I have seen that some mention these paragraph references over here only. Then besides, J talks about any such matter as may be prescribed by the rules. So here, of course, that I will tell you that we will be covered in the separate slide. But here I would just like to tell you that, section 197 was amended, and 197 initially Caro covered that, the auditor had to report on whether, the remuneration paid to the directors are adequate or no, as per the provisions of the Companies Act, whether the remuneration paid was not in excess of the limits laid down by 197. Initially, Caro had it, then Caro removed it, so therefore it was included here. And then again now, since it is 197 12, I think. So 197 16 is amended. Therefore, the auditor has to report in 143.3. Again, from Caro 2020, this clause has been removed. So therefore, again, whether an auditor, whether any director excess of the limit laid down under the Act also has to be given here. So that is how it is. So any other matter as may be prescribed, that probably is the Rule 11. And what does Rule 11 talk about is that Rule 11 under 143J talks about whether the company has disclosed impact, if any, of the pending litigation on its financial position in the financial statement. So friends, here I would like to pause for a minute again and just bring to your attention that whenever we are drafting an audit report or signing an audit report, be little careful, be little alert, and see what is the requirement. The requirement is that whether the company has disclosed impact of any pending litigation on the financial position. So therefore, just don't blindly, ignore this. So if the company has a disclosure, separate disclosure of contingent liability, which is required under which is required under Schedule 3 and as per the applicable accounting standards also, then that litigation would be disclosed as contingent liability. If there is a pending litigation and there is contingent liability, the auditor will have to cross-reference that particular note in his audit report here. If there is no contingent liability in the company could be rather new, or there could be no pending litigation. Then if the company says that yes, the company does not have any pending litigation and therefore this disclosure is not made, it's fine. But if I have seen certain audit reports where there is contingent liability and the auditor mentioned over here, it says that the company does not have any pending litigation. So please, friends, just keep this in mind, that if contingent liability is there, cross-refer it over here. Then whether company has provided for all material foreseeable losses, if any, on any any long-term contracts, including derivative contracts. So this is an additional audit procedure that we will have to carry out to report on if any long-term contracts are there and any foreseeable losses are there on that, then we'll have to mention. So therefore, if the so this is including derivative contracts. So you'll have to inquire with the company, and if the company particularly is into constructions or has some of these long-term contracts which it sees that in the foreseeable future there is going to be material losses, then they will have to report on that. Then it has to also report on whether there has been any delay in transferring of amounts to investor education and protection fund. This would be more applicable in larger companies and listed companies where certain shareholders are not available or certain dividends are not being allowed, are not getting credited or not being paid, even though the company is making that payment, but there is no shareholder claiming that dividend. After X amount of years, it has to be transferred to investors education protection fund. So whether there has been any delays, that has to be mentioned. Friends, I would here, also mention that under this Rule 11, besides this 3, there was earlier, relation to or disclosure on the specified bank notes, SBN, which was called. So that also was there, and it was not withdrawn formally until I think so March 21. Then in March 21, the notification came where there was a deletion of clause D on that specified bank note. So therefore, earlier, this specified bank notes came particularly at the time of demonetization, where during demonetization, certain amount of notes which were demonetized, the company had to report it and the auditor also had to report. But this was just continuing. That was applicable for a year or so. And then after that, because that was that limited period of time was available to deposit that specified currency notes. So that was there. But yet, since it was not officially withdrawn, certain companies or certain firms had taken a stand that you need to, even though it is not there, not applicable, you need to continue. So that ambiguity or that inconsistency has been deleted and that clause has been deleted. But in place of that clause number, new clause E, 1, 2, 3, and clause F and G were inserted, which come into effect from April 21. So March 22 will be the first time when an auditor will have to report on these additional clauses, and I will tell you what these additional clauses are there. Then on 1st of April, there was another notification where clause G has been, deferred from accounting years beginning from April 22. Now let us see what this notification was. What did this notification say? So therefore, as I told you, D was deleted, which related to specified bank notes. The clause E1 that came was that, clause E1, which said is that whether management has represented that to the best of its knowledge and belief, other than as disclosed in the notes to accounts, these two type of transactions have not happened. So this is clause E1 and 2. It talks about, and this clause talks about, this particularly requirement has come from, certain fallout of certain company failures or NBFC failures or, certain frauds that have taken place, wherein there has been round tripping of loans and, directly loans have not been given from one entity to another, but just to protect the, the ultimate source or the identity of people giving the loans and getting the loans. It was routed through some third party or routed through some intermediary. So therefore, the responsibility has been put on the auditor to look into specific these type of transactions, that whether funds have been advanced or loaned or invested by the company to or in any other entity, which includes foreign entities, with the understanding that, that particular company or that intermediary company shall directly or indirectly further invest or further give that loan to person or entities identified in any manner whatsoever by or on behalf of the company, or provide guarantees and securities on behalf of the ultimate beneficiary. So here the ultimate beneficiary is person who is actually giving the loan on behalf of which the loan has been given, and the intermediary is the third party in between. So I'm not reading this because it is self-explanatory, but this also, it's very wide, and it includes whether the understanding is written or oral, whether the party is, foreign or, an Indian party, or it is a person or an entity. Entity would cover any type of organization, NGO, trust, etc. So it's a wide and a very challenging and a very, it's like, these type of transactions many a times, in India typically happen because of related parties. But imagine a situation where the company is actually in the business of giving loans only. So therefore, unfortunately, there is no exemption of reporting on this format to NBFCs or banking companies. Leave aside public sector banks, but private companies are banking companies. So reporting is important as far as this is concerned. So imagine the difficulty and the challenge, practical challenge that would happen. So therefore, no doubt people have found out ways how to disclose this. The AASB has come out with an advisory also. So people are following that. And immediately opposite, similarly, exactly opposite is that no funds have been received. That is the clause B additional required, that initially talks about company giving loan. Here it talks about company taking the loan or getting that money, receiving that money from such person, and then further giving it or investing to somebody on behalf of the person who has ultimately given you that loan. So it talks about that. Friends, I just would like to stop over here because I don't want to get into this, because if we start discussing this, we will lose another half an hour, because how to interpret ultimate beneficiary, I think industry has taken, various companies have taken different stands, but I don't want to, this is also not a very, straightforward as it looks, because some companies have taken some stand, different companies have taken different stands. So therefore, this also is an anomaly, but I would leave it at that. And when I come to the audit report, I will show you how it has to be reported and how companies or how firms have reported on this. Then also clause E3, which talks about that whether what audit procedures has the auditor carried out. So here it has come that, based on the, such audit procedures that the auditor has considered reasonable and appropriate in the circumstances, nothing has come to the notice that causes him to believe that the representation made in point number 1 and 2 above contain any material misstatement. So here, first and foremost, the requirement of 1 and 2 was there, that the management has represented, and that to the best of it knowledge, other than that, what is disclosed. So therefore, there is actually first the requirement of the management to disclose in the financial statement. So friends, just take a pause here and see what is the requirement. You have to require whether the management has represented, and to the best of its knowledge, that other than those disclosed in the notes to account. So therefore, make sure that whenever you are filing, formalizing or forming your opinion of finalizing your audit report, first the responsibility is on the management to disclose that. Even though there are no such loans given, they will have to give that disclosure, because you are mentioning in your audit report that other than those. Otherwise, God forbid, if the management has not disclosed and you give it, then you might, or one might face an, a disciplinary action or FRRB action, that, okay, that disclosure, or you should have ensured that the company has made that disclosure, but the company has not made that disclosure. So whatever will happen to the company, that is separate, but we have to protect ourselves, that what needs to be done. So therefore, Institute has come out with a guidance, and of course, Schedule 3 changes covers all these points. So therefore, make sure that there are, this year, March 22, there are some additional 12 or 14 points where, based on CARO and the changes in Schedule 3, management will have to give some additional disclosures. So make sure that the company has done that. So this, friends, was all which was called that, evergreening, or giving this multiple loans, etc., etc. So as I told you, yes, this would be a problem where family run companies are there, and multiple group companies are there, and related party loans are running from here and there. So be careful. If you are auditor of such company or such group, be careful. Also, this will be a challenge in reporting to NBFCs and banking companies, etc., as I told you. Then new clause F, which is inserted in the current year, and we'll have to also given, also report on that, is that whether the dividend declared or paid during the year by the company is in compliance with Section 123 of the Companies Act. So Section 123 of the Companies Act also mentioned that the company can pay dividend from the current year's profit after appropriate depreciation, etc. And after that, whatever profit remains, the company can pay profit. So here, the auditor will have to go and check whether the audit, of course, this was a normal procedure that you were doing only, but here now you'll have to specifically do this exercise and document it, that how you have checked. Friends, here the challenge here would be that, Section 73 also talks about, if acceptance of deposits is there. So therefore, if there is a non-compliance of Section 73, those type of companies are actually debarred, or cannot declare a dividend, etc., out of reserves, and out of reserves. So therefore, if there's a default in failure of paying the deposits, etc., so keep these various things in mind, and then see the compliance of 123, adequacy of profits, and whether the company has paid and declared dividend adequately. Friends, here also you need to keep in mind is that dividend declared and paid during the year. So here, not only declared, so say for example, now we are reporting for financial year 21-22. So what you will have to see is that, the dividend declared and paid. Declared means for March 22, there would actually be declared, means there would be a proposed dividend. So imagine a company wherein a big lucrative profit making company which pays interim dividend also, and which pays final dividend also. So first and foremost thing, proposed dividend of the previous year, March 21, which the AGM, the shareholders might have approved and would have been paid in 21-22. So that also he has to check, and auditor has to check, plus any interim dividend for 21-22, that also auditor has to check, and the proposed dividend for 21-22, which will be paid in the next financial year 22-23, also auditor will have to check. So please keep that in mind. Luckily, the next subclause G, which luckily for all of us and for the company, which has been deferred, thankfully, to financial years beginning from April 22, has been got deferred 2 times, is the auditor will have to report that whether the accounting system or the accounting software or the package that the company is maintaining is strong enough that it records any audit logs, that it records any modifications to transactions or any, and it prevents that, modification, or even if it allows that modification, there is an audit trail wherein, the company has preserved that audit trail, that, okay, who has changed. So imagine that we are doing audit of a company in Tally. Tally is such a user-friendly software. So whether Tally or any other software will be actually adequate to, maintain that tampering with the audit system, or, even changing. Forget tampering. Even if there's a change, there's a genuine mistake in genuine mistake in passing an accounting entry, which has been rectified later on. Many a time some accounting softwares allow you just to override the transaction. So you have to make sure that this, your software has those points which does not allow just these modifications, but it locks the transaction, and you have to pass a rectification entry. I believe Tally is also working out and will come, but only unfortunately the requirement over here is that you will have to give audit your opinion on whether it has been operated throughout the year or no. So friends, this is the challenge, but of course it's not applicable for audit for March 22, but it will be applicable for the current financial year, which is running for March 23. We will have to give that. So therefore, then again, moving forward, so that was just 143.3. And I would just like to pause here for a minute, and I would like to show you how the audit report looks for a minute. And I will just take you on to can you see my screen?
Yes, sir. It is Word file is coming. Yes, sir.
Yes, yes, thank you. So here,
Okay.
if you see, uh, this is an audit report wherein we are talking about report on other regulatory requirements. So this is exactly what I was talking about, requirement of section 143(3), which talks about whether, he has sought all the information and explanation, whether in his opinion, books of accounts are as per the, kept as per the, law, then whether the balance sheet, profit and loss are in agreement with books of accounts, whether the accounting standards have been followed, whether any of the directors have not been disqualified. Then on IFC, another annexure he has taken. Then 147.60, 197.16, any remuneration has been paid. Then in the opinion and to the best of explanation provided, the remuneration is so and so, is not, is paid, is not paid in excess. Then rule 11 here, whether the other matters under rule 11 as mentioned herein, the company has disclosed the impact of its pending litigation on its financial statement. This is what I mean to say. This is what I have highlighted here, whether the company has disclosed any, litigation impact here. So therefore, here many a times I've also seen that many auditors give refer note so and so to the financial statement. So that would also not be wrong. This is on, unforeseeable losses of the accounting standard. Then this is the new requirement which has come. The the clause 4, that the management has represented that to the best of its explanation, and found that no material individually or aggregately has been advanced. So this is the exact verbatim reproduction of the notification that came, the rule of the change in rule 11, which was there. So these 2 points are on that, whether loans have been given and loans have been received. And then based on the audit procedures followed by the, nothing material has come, that he to makes us believe that this is not correct. Then on the next part is on the dividend. You can read over here how it is given, that as stated in note 2.12.3 of the standalone financial statement, the final dividend proposed in the previous financial year declared and paid by the company during the year is in accordance with section 123 of the Act as applicable. Interim dividend declared and paid by the company during the year until the date of report is in compliance. So therefore, there may be some companies pay 2 or 3 interim dividends. So he is making very clarifying that until the date of his report, the interim dividends paid for the year are in compliance. And last, the board of directors of the company has proposed final dividend for the year, which is subject to approval of members at the ensuring AGM. The amount of proposed dividend is accordance with 143.3. So this is, friends, this is the, the new requirement under 143.3 which has come. So I think so this, clearly it gives, and this is an audit report is available in public domain. So it's nothing new from, my side that I have got. It's available in public domain. So that talks about 143.3, which talks about other regulatory requirement. Also, which in this report was not qualified. So therefore, okay, let me do one thing. Let me skip back and immediately show, wherever there is, okay. This is an audit report where it has certain amount of, uncertainty of going concern and emphasis of matter. And if you see, friends, here in this other regulatory requirements here, you see how it has been mentioned, a 143.3 requirement that the balance sheet, statement of profit and loss, including statement of other comprehensive income, statement of changes in equity and cash flow dealt with are in agreements with the books of accounts. So this is this. And see here, the matters mentioned under the uncertainty of matter paragraph, uncertainty relating to going concern and emphasis of matter paragraphs above in our opinion above may have an adverse impact on the functioning of the company. This is what I was saying, that the requirement on 143.3 are there. So therefore, this is more important. Had this company been a qualification, then also it would be a qualification of whether as per the applicable accounting standards, then this particular paragraph D here, which is here, would have to be highlighted that yes, this particular paragraph, that okay, it complies with the accounting standards except to the impact of the disclaimer of an opinion or adverse opinion if our mentioned above would have an impact. So that would have to be, these particular paragraph would have to be modified. So now coming back to the presentation, so this is how in actual life it is done. Now coming back to the presentation, of course, now I would quickly like to cover this. 143.4 talks about, the requirement for highlighting. I told you has gone, because immediately you will have to mention in the separate, that if any of the remarks required in the audit report are in the negative, the auditor will now have to quantify it as far as possible and give an, reply on impact on the financial statement. Then 143, 5 to 7 talks about reporting to, to CA, Computer and Audit, Controller and Auditor General for government companies. So I'm not mentioning on that. Branch auditor's responsibility is the same as 143, 143. 4 and 143.12, so that is just that. Then 143.9 and 10 talks about auditor's responsibility to comply with the standards on auditing, which have to be notified by NFRA, but NFRA so far has not notified. So those which have been issued by Institute of Chartered Accountants of India only are applicable. Then 143.11 talks about CARO. So that is that matter. Again, I've told you that this is not the matter for discussion, but the CARO comes from 143.11. Then this is reporting on fraud. What is the responsibility? And 143.14 and 15 talks about the penalties and that. So therefore, this is where what is required. We all do the audit report, but we never went into the background that why this particular audit report, why do we write this, why do we write that comply with the accounting standards, and that we have sought information, we have sought explanation, etc., etc. Why we never question. So therefore 143.3 fully gives you that background, that why it comes. Now coming to the standards of auditing, friends, just I would like to mention here, I'm very passionate about auditing, because that's my bread and butter. That's how, I've done all my life. That's how my, that's my passion. That's what I do. That's how my, it's that my house runs. So therefore, we as chartered accountants only have the monopoly right now to do the audit so far. And thank God that monopoly has not gone. Statutory audit can only be done by chartered accountants in India. Friends, so therefore, complying with the standards on auditing becomes our Bible, becomes our most, what do you say, most important. Friends, but I've also observed what happens is that we run after, as it was mentioned by Anuj in the beginning also, that we are very, passionate about profit kya hai company ko, profit kaise usko dikha sakte hai, tax kaise bacha sakte hai. So we run after accounting standards. Friends, we are not accountants, we are auditors. Today, I have seen that chartered accountants, excellent knowledge they have about accounting standards. But friends, ultimately, what if they are auditors, they need to know the standards on auditing. If there is a mistake in accounts, if there is a mistake in financial statements, if there is a mistake in tax work, who's going to suffer? The company is going to suffer, the client is going to suffer. But we are passionate to protect them. But if there is an audit failure, if we don't follow standards on auditing, if there is unfortunate situation where disciplinary action or our financial statements are chosen and there are certain, mistakes are pointed out, then who's going to suffer? We are going to suffer, and no client is going to stand by us. So be careful, follow the standards on auditing very diligently. As I told you, these standards on auditing are at par with international standards. To have consistency in reporting, to have in the sense, what do you say, comparability between two different audit reports, all these standards have been upgraded. Now these are the series of standards on auditing which are there. What we will be dealing today is with the SA 700 series, and as was mentioned earlier, SA 700 actually, SA 700 series, what we will be doing is covering SA 700 revised, which talks about forming an opinion, that is the main audit report itself. 701, 705, 706, which were revised. 705 talks about modifications in an audit report, and emphasis on matter and other matters are covered in 706. 710 710 talks about comparative information, 720 talks about auditor's responsibility on other information, and 701 talks about communicating with those charged with, communicating on key audit matters in the independent auditor's report. So friends, why I've highlighted 701 is that 701 is only applicable to listed companies right now. But at the discretion of the auditor, if he wants to give, he's free to give key audit matters. So friends, why was this, all these 700 series were revised recently in 2018, because our friends will recollect that prior to 2018, our audit report format was different. And after post 2018, the report is format is different, because earlier, our audit opinion used to come at the end. But now, to make it comparable to international standards or in line with international standards, it has come up. So there was project which was carried out, and therefore it is important to comply with the reporting standards to make it, so therefore there is consistency and it becomes relevant, that okay, an auditor, the audit report should be self-speaking. It should not be, it should be self-explanatory, that in the absence of an auditor, if a third party or the user of the financial statements is reading an audit report, he needs to understand what the auditor wants to say. Okay, he has done all his effort, he's collected all the evidence, he's had all the queries, he's solved all the queries, he has collected evidence, spoken to the management. Based on that, he comes to a conclusion. Now, what is his conclusion? His conclusion is on his opinion, and his opinion he has to, so therefore the opposite person should understand exactly what the auditor is mentioning. So therefore, to have this standardization, to have this irrelevance, to have this comparability, this particular standards were revised. I'll just drink water, just 1 minute. Besides these standards on auditing also, there are various implementation guides, there are various clarifications, there are various FAQs that the institute, the AASB has come out with. And friends, I strongly recommend that just reading the standards or just doing a Google search, please don't do that. A lot of material, all material is freely available at the institute website. Download, keep it, and use it whenever you require. So not only that, besides the implementation guides and besides the standards itself, there are a lot of illustrative formats wherein under various circumstances, how to report, what to report, which paragraphs comes where, etc. Everything has been given in detail. So please refer to that. So therefore, also during COVID, these were the various advisories or various, some clarifications that the AASB had come out with. So these also have not been withdrawn, but now the relevance has become lesser. But if you require any of them, then you can refer to that. So therefore, as I told you, why were these amendments required? What was the need of the amendment? So here the International Accounting and Assurance Standard Board had said that the auditor's opinion on the financial statements is valued. However, in wake of global financial crisis, many have called for auditors' report to be more informative, in particular for auditors to prove more relevant information to the users based on the audit that he has performed. So therefore, there was a need to revise these audit report standards, and therefore it was these standards were revised. Now coming to overall exactly what we are going to cover today as far as these standards, we have about another 50 minutes, so about next 40 minutes, and then I will leave 10 minutes for question and answers. What are we going to cover today? The full revision on standards on audit standards or audit report covered first SA 700, which was revamped fully. So that is the main revision, wherein how the auditor writes his opinion, how he frames his opinion on the financial statements, etc. is there. Then, as I told you, 705 talks about modifications in audit report, that if he changes what is mentioned in 705, then it is said to be a modification. And friends, for people from my generation, modification mean nothing but qualification. It is, used in tandem. So whenever I say modifications, it would mean a qualified audit report. But now the technical word for qualification is modification of an audit report. Then what is emphasis of matter and other matter paragraph? When an auditor should give emphasis of matter, when an auditor should give other matter paragraph, guidance comes from 705. And for qualifications or modifications comes from 705. And for emphasis of matter comes from 706. What is the difference between EOM, that is emphasis of matter, OM, other matters, and qualification, that we will be covering in the slide. Then friends, 720 was a new animal, 701 is a new animal which have come. 701 became applicable to listed companies, and again I'll be covering. But unfortunately, 720, though it looks as if it is an harmless standard, it might have some important ramification, which I will be covering in my presentation when I go to SS 720. 720 is the responsibility of an auditor reporting on other matters other than the financial statements, other than on his opinion on the financial statements. And unfortunately, friends, 720 is applicable to all companies, irrespective of whether it is small, one person, or it is listed, etc. Unlike 701, 720 is applicable to all private, public companies. And because these mother of all reporting standards changed, there were consequential changes on all other standards. 260 on, communicating to those charged with governance on important matters, that required change. Documentation, 510, 540, 600, 210, 220, all these required changes. And friends, also, though I think so, if I don't cover the changes in SA 570, I think so my presentation on audit reporting would be incomplete. So therefore, I will spend considerable amount of time on SA 570, that what it talks about, and because of the changes of SA 570, when an auditor needs to report or be careful about reporting. So therefore, now what are the type of statutory audit reports? The statutory audit reports are of two types. One are clean audit reports, which are covered by SA 700, and the others are modified reports. And modified reports are which are covered, the guidance we get from SA 705. And within modified also, or within qualification also, what type of opinions you could have? You could have either a qualified opinion, either you can have an adverse opinion, or you can have a disclaimer of an opinion. So qualified opinion would mean that subject to so and so, this statement gives true and fair view. Adverse means it does not give a true and fair view statement. Financial statements do not give a true and fair view. And disclaimer means that I do not have adequate information, or because of XYZ reason, I am unable to express an opinion. Am I very clear that modified opinion could be qualified? Qualified means it gives a true and fair view subject to non-compliance of A, B, C. That is called qualified audit report. Adverse means it does not give a true and fair view. Absolutely, it's wrong. So that is adverse opinion. And disclaimer of an opinion is that because of X, Y, reason, or because of unavailability of information, fire at this thing, the CBI taking all the information, I'm unable to give an opinion, that would be disclosure. So whenever you have any of these three scenarios, refer to 705. And coming to clean audit report, could be plain, simple, vanilla clean audit report under 700. Or if you decide to give an emphasis of matter, then you refer to 706 on what matters that you have to give an emphasis of matter, or when you have to give, or how you have to give, under what circumstances, that is advice is given. And besides 706, if there is any other matter that you want to disclose in your audit report, again, take guidance from 705. Now, what does 700 talk about? The 700, talks about, it is, as you all know, that the audit report expressly has to be in writing. So essay, I'm not going through the definition, etc., but I'm just taking you through the standard, because if I take you through standard verbatim, sometimes the presentation becomes dry on standard and auditing. So I'll tell you more practically exactly what is to be done. So therefore, what is the engagement? The statutory auditor is engaged to do the statutory audit and express his opinion on the true and fair view. So therefore, whenever he expresses his opinion on the true and fair view, he has to give an audit report. Now, SA 700 is only applicable to the statutory audit when he does audit of a general purpose financial statement. And what do you mean a general purpose financial statement? General purpose financial statements, or or general purpose financial statements are those which are prepared under the general purpose framework. So therefore, whenever financial statements are designed, or the framework is designed to meet the requirement of a large number of the consumers of these financial statements, or consumer, or you know uh, uh, say for example, income tax department, shareholders, the ROC, etc., etc. So whenever these financial statements are prepared to keep the large viewers in view, then those are called general purpose financial statement. But if you have, say, a director or the management comes to a company and say that, okay, the financial year ends on March, but we want to do a buyback, or we want to introduce a new investor in it, so, or we want to evaluate how internally we have worked. Could you please do an audit only for a period from January to December? Then it would not be called a general purpose financial statement, because these financial statements are not available to the general public, or to the higher or to the bankers, or to the institutions, etc., etc. So therefore, those are called special purpose financial statements. And when you do the audit of special purpose financial statements, do not give an audit report under SA 700. For that, the standard on auditing 800 is different. So keep that in mind. So therefore, the objective of SA 700 is that whenever the auditor is doing audit of a general purpose financial statements, based on his evaluation and based on what audit evidence he has obtained and drawn, and on conclusion that he has drawn from that audit evidence, and the explanation and information he has got from the management, whatever his opinion is there, which he issues in writing, is what the objective of SA 700 is. As I told you, how to give that opinion, SA 700 gives. What to include in that opinion is by the 143 Companies Act. So therefore, this covers only, it does not cover qualification. It only covers those reports which are clean reports, who do not have qualifications, and so besides SA 700, besides the implementation guide, also there are various illustrative formats issued by the Institute of Chartered Accountants, which you need to look into before finalizing that, or you can take use of it. So therefore, now what does it talk about? What is, SA 700, what does it cover? So SA 700 gives you, first and foremost, the title, that it's a statutory audit report, standalone, or consolidated audit report, auditor's report. Then addressee to whom it has to be addressed, as I told you. So naturally, general purpose financial statements are usually always addressed to the shareholders of the company. So that addressee. There was certain amount of also in say public sector banks, because since the government of India is holding majority, so whether the audit report should be addressed to the president, etc., etc., also is a matter of debate. Then immediately after the addressee, he has to give he has to give the background in that addressee, that he has audited the financial statements for which year, what does the financial statements include. So that has to be addressed. Then he has to give his opinion, that what is his opinion, that whether the financial statements are presented true and fair view, first and foremost thing, for which period. So that he has to give. Then, okay, if he is giving a true and fair view, what is the basis of his opinion? Suppose if he does not give a true and fair view, then what is the basis of his qualified opinion, etc. Then Going concern paragraph wherever applicable. So here I will be spending some time on going concern, how to report on that. So this I will be spending. Then if the auditor gives any emphasis of matter, then that paragraph on emphasis of matter would come. Then key audit matters under SA 701 for listed companies, and then other information applicable to all companies under SA 720. Then you would get the management's responsibility on the financial statement, then the auditor's responsibility on the financial statement, then other matters, then other regulatory matters. As I told you, report on other regulatory, legal and regulatory matters, 143.3, which I told you, signature, place of signature, then date on the audit report, and then the unit. So this makes a complete audit report under SA 700. So this is what I told you. Then his opinion, as I told you, after the addressee, then what is the opinion? The opinion is the opinion that he has to give on the auditor's report should also include, first, he will have to identify the company, state what is the financial statements, identify each element of the financial statements, as I told you, balance sheet, profit and loss. Friends, here also, keep one thing in mind. Many a times we've observed that though the company cash flow is applicable, cash flow is given, or the management has prepared the cash flow in the auditor's report has forgotten to actually mention it, that it is, cash flow also is part of the financial statement. So please, just don't do a cut copy paste job. Remember that if you are doing audit of an Ind AS company, besides the profit and loss statement, besides the balance sheet, besides the statement of profit and loss, you will, and besides the cash flow, you will also have statement of changes in equity. SOCI also will come. So therefore, not only that, but even in your basis for opinion, also in your opinion paragraph, you'll have to give that, yes, the balance sheet gives a true and fair view on the date of the balance sheet. The statement of profit and loss account gives a true and fair view of the state of the profit or loss during the year. Cash flow gives a financial statement, cash flow statement gives a true and fair view of the cash flows during the year. So that is what we have to give. Also refer to the note and summary of significant accounting policies also in the financial statement. So when I take you through the paragraph, so, first the institute illustrative format only gives that you have audited or we were engaged in the engagement of statutory audit for so-and-so company for so-and-so year, which includes, and we have audited the financial statement. Then you'll have to give the, what these definitions are, and then based on your procedures and all that, what is your opinion? Then basis of your opinion also, you'll have to give that, state that the audit was conducted in accordance with the standards on auditing. So therefore, now the heading, opinion was there, but the basis of opinion just used to be part of the opinion. So therefore, there will be a separate paragraph with the heading basis of opinion that comes. Here you will also have to refer to what is going to be, what were your responsibilities as an auditor and what was the management's responsibility. So that also would come. You would also have to give that you are independent. You are not only independent as per the requirement of laws, but also by the code of conduct, you are independent. That, because there is certain amount of restrictions on independence, not only by Companies Act, because say, for example, if you are the shareholder, you cannot do the audit, etc., etc. So therefore, you are indebtedness. So you have to be independent. Then there are certain amount of independence from certain regulatory requirements, for example, banks, insurance companies, etc., etc. So therefore, your independence could be a problem. So therefore, you have to give a declaration that yes, you are independent. Then you have followed the standards on auditing which were required. You are, you followed the ethical requirements of the code of conduct, and then you will also have to give a that whether you believe that the audit evidence that you collected were sufficient and and appropriate, that you could give your opinion, etc. Then going concern. Okay, then going concern, I will just park it aside, but if there is a going concern, how to report on that? Let me go by the flow of SA 700. Then key audit matters. So, for listed companies, that would be the key audit matters. Then on management responsibility on the financial statements, friends. Here you have to be very careful, and you have to first and foremost thing know also that the responsibility of the management is first to prepare the financial statements. It is not the auditor's responsibility. Otherwise, it would be a self-review that you are only making the financial statements and you are only, auditing them. So the financial statements have to be prepared by the management in accordance with the accounting standards applicable under 133(3). So therefore, if it is Ind AS or normal IGAAP, and they prepare and present a proper and adequate disclosures are made. So therefore, it is the responsibility of the management. It is also the responsibility of the management to design, implement, and maintain adequate internal controls that are operating effectively and efficiently throughout the year. So that is, and completeness of the accounting record, that is there. And the assessment of the company's ability to continue of the going concern, that assessment also the initial responsibility there of the management. Friends, why am I also, insisting on going concern? Because it is become important, and the company, and now, the standards have become more stricter, and the response, and because of the going concern issues that everybody, the word going concern itself comes more than 7 or 8 times in the full audit report. And if a company has got going concern issues, or if you are giving an additional material uncertainty paragraph, then the word going concern may come up to more than dozen times, etc. Then the auditor's responsibility, first and foremost thing is, what is the objective of the auditor? Whether then he has to state that, he is giving a reasonable assurance. Here he cannot say that I am giving a negative assurance, or I'm giving, a limited assurance, because here a limited or a negative assurance you could give in a LR or a limited review that you do, which is not covered under SA 700, etc. So therefore, that he will have to give, and it also binds himself that, okay, that though it is a high level of assurance, but it does not guarantee. Why? Because he will he has done the audit as per the standards on auditing, and standards on auditing allow the auditor to use a test check basis, or to select samples and carry out audit procedures on those samples, and then form his opinion. So it's a complicated issue, so therefore that he has to give. Then he also has to state that, yes, according to his opinion, there are no, material misstatements that arise, that could be a possibility of material misstatement, but there are no material misstatements. Then he also has to state categorically that he has exercised his professional judgment, he has maintained his professional skepticism throughout his audit, and also, more additionally, his responsibility also would include that he has gone through, assessed the assessment of the management of the company to continue as a going concern. He has, he's, what do you say, satisfied with the management estimate, or, the appropriateness of the assumption that the management has made. Then he has evaluated the appropriateness of the accounting policies and the estimates, and he's okay with that. Then he has to give a disclaimer as far as, that, yes, this is important over here, that's why it is highlighted, that he has obtained an understanding of the internal financial controls reporting to, relating to the financial statements. And here, friends, always I have seen that there is a mistake that auditors do. This particular paragraph has to be amended whenever he is giving an opinion on the internal financial controls related to financial statements, or if he is not giving an opinion. But many a times I've seen the juniors work on that, and then the main signing partner also, forgets to amend this or etc. So whenever you are doing a checking of the audit report, please ensure that if you are evaluating and giving an opinion on the internal financial control, then you modify this paragraph accordingly. Then that's fine. Then if he has used the work of an other auditor, then he has to clearly bring about that division of responsibilities, how he has dealt with, etc., etc. Then also, these are the additional the reporting auditor's responsibility, and this is clearly taken from the standard itself only, that it is, he understands that it is his responsibility to communicate with those charged with governance and other matters. He has planned his audit in such a way, the timing he has planned it, that gives us that helps him to opine on the financial statements and etc etc. He, any deficiencies were there, he has dealt with them properly. Then all these points that we need to cover. Then also, okay, so that talks about all this responsibility. Now, based on this SA 700, now let me just stop and take you through the pitfalls that many a times I have observed, or many a times the auditors do, as far as audit report is concerned under SA 700. So friends, here I have shared the new screen, and you can see a live audit report which of a company is there. So friends, whatever I have highlighted in red is where, based on the illustrative format the company has given, you need to check this. First and foremost thing, yes, to the independent, or I mean, this is an independent auditor's report. Then you have to address it to whom, which, and then this is the title. Here you have to be careful, here I have not mentioned over here standalone financial statements or consolidated, because this is only, this company does not have any associate or a subsidiary, so therefore it is not preparing consolidated financial statement. So friends, be careful that whenever you say financial statements, if the company is also preparing consolidated, then the word standalone should come before the financial statements everywhere, not only in the audit report also, but even if the financial statements which are getting signed, standalone financial statements should come. So this is where it is important that this is, wherever financial statements you are giving, you have to keep in mind that you include that. Then we have audited the financial statements of the name of the company which comprises of the balance sheet, statement of profit and loss, which includes other comprehensive income. So in non-Ind AS companies, this would not be there. So you have to be careful. Statement of changes in equity for non-Ind AS, again, this would not be there. Statement of cash flow. So be careful in small companies, if cash flow you are not giving, not applicable in 1% company, then don't mention this cash flow statement for the year ended on that dates, and the notes and the financial statements, including a summary of significant accounting policies and other explanatory notes. So this is full, this means the financial statements. So that is what he has audited. So this is his opinion paragraph. Then in his opinion, then to the best of my information, explanation, so and so, the financial statements so required give a true and fair view in conformity with the applicable Indian accounting standards prescribed, because this is under Ind AS. So therefore you have to say either whichever the accounting standard framework is applicable under section 133, read along with the rules thereof. So that is what you have to give. And the accounting principles generally accepted in India state. Then here, this is your last two lines. This is your opinion paragraph. Again, you keep think that whether the state of affairs as on 31st March, if it is loss, then loss of profit, including the other comprehensive income, statement of changes in equity, and cash flow statement. I have also seen where here cash flow is given in the top line, that it includes in the financial statement, but in the opinion paragraph, people have forgotten to mention these are small mistakes of not very consequent, but these are, life-taking mistakes, so in that way. Then in the basis of para opinion, again, I gave you the reference of standards on auditing come and the ICA code of ethics on the independence come. So therefore, this is what is important. Then friends, here I'm, pausing and taking you through the, material uncertainty relating to going concern. Prior to the amendment of, standards on auditing of 570, there was no particular requirement to have this note separately. But even the revision in 570 triggered everything, and reporting of material uncertainty of the ongoing concerns is triggered by the change in standard on auditing of 570. The AASB also came out with very lucid implementation guide, and also for certain clarifications came out with an FAQ at that time. So refer to that. So whenever the auditor feels that there is material uncertainty on the company to continue as financial state, to continue as a going concern as a financial statement, and there are indications thereof. Now, what would be the indications? Again, 570 gives you that indication that, what would be the indication that suppose, will the company be able to meet its immediate liabilities? Are the current assets enough to meet its immediately financial obligation or immediate liabilities? Then the other indications could be continuously cash losses incurred, the net worth getting wiped off, etc., etc. So many other variety of reasons could be there. Some, the company is only into one important product and the license of it gets cancelled, etc. So many reasons can be there. So whenever there is a material uncertainty on going concern, you have to give that note. And also, there is guidance when we do on the qualification, wherever, what leads to modification or what leads to EOM paragraph also. Suppose if the management has considered this material uncertainty and he has disclosed, that yes, there are these reasons where there could be a problem of going concern assumption, but because of these reasons, we feel, say for example, a letter of comfort is there from the promoter company, or the commitment letter is there that if as and when the money will be required, the holding company or the parent company will make hold this money, or there is a future profitable contract that the company has entered into, so therefore it will turn profitable, or it will, from its lenders, it will be able to negotiate, a one-time settlement, or refacement of his loans, etc. These are the reasons why, where going concerns can be assumed that, because of these reasons, the going concern assumption is correct. But there is definitely a material uncertainty. Therefore, you give that reference to the material uncertainty paragraph. Then you also give the reference to the management's note in the financial statement that they have given, the reasons why there is doubt in the auditor's mind that there could be going concern issue. Then also give reference to that because of the points mentioned, or because of the favorable conditions mentioned in that particular note, the management is confident that it will continue as a going concern. So therefore this is full reference. So therefore, whenever we come to SS 706 or something, so therefore it talks about that, okay, if you are giving a material uncertainty paragraph, then you do not cover this in 706. So don't repeat this in the EOM paragraph again. So therefore, this is how it is. And finally, it says that, you have to end with the statement of your opinion is not modified in respect of this particular matter. That is how it is. Then your emphasis on matter comes. Similarly, you give reference to the matter, why that emphasis on matter, why you want to bring it, and you give other opinion is not modified with respect to these matters. So what to give EOM, again, immediately after this, I will be covering, but this is how you have to give a reference. And the standard says that whenever you give an EOM or material uncertainty, it is the responsibility of the auditor to clarify that his opinion is not modified in respect to this matter. So this is where you have to mention it, so don't forget to make this line. Then this is 720. Wherever we will be covering this is what I will be covering. This particular company is not listed, so 701 is not there. So otherwise, first 701 key audit matters would come, and then this would come. So therefore, this, friends, I told you, this is a little bit of a dangerous, though it seems unconsequential, or it might be harmless, but there is little bit of a catch which is in 720. So you'll have to take care of that. So this is 720 paragraph, and I will be mentioning that this, I told you, is the responsibility of the management. So you give that audit management's responsibility, which I showed you in 700. Then auditor's responsibility, huge paragraph here. Friend, this is where I was telling that in this particular, here, where the auditor is saying that as part of my audit, in accordance with the standards and auditor, I have exercised professional judgment and maintained professional skepticism throughout my audit. And I also have obtained an understanding of the internal financial controls relevant to the audit in order to design the audit procedures and are appropriate in, because are in appropriate and circumstances under section so and so, and our opinion whether the audits have been adequate or no. So therefore, we are also responsible for expressing an opinion on whether the company has adequate internal financial controls and these are operating effectively during the year. So this company is required to have IFC. So therefore, in this audit report, the auditor has given that we are also responsible for exercising. But if the company is a small company and IFC is not applicable, then you just see that you amend this paragraph accordingly. But though we are not responsible for expressing an opinion, should be covered in this. Then this is, as I told you, 11, subsection 11 Caro. So an additional annexure as far as this thing will come, as far as Caro will come. So we are not discussing this. I have already disclosed here, as I told you, that the accounting standards are, and in agreement with books of accounts. And as I told you, 143 mein other requirement hai that what is the, adverse impact, then that particular reference has to come. So this I have covered with you. Now, coming back to our presentation on the standards on auditing. Now, this is what I've covered. Now, when do we, qualify an audit report? When an auditor would feel that, he has to qualify an audit report, he will have to, qualify his audit report that if, based, so the guidance from SS 700 is, or during the course of his audit is that auditor, if, he feels that, uh, based on the circumstances and based on the audit evidence gathered by him, and he has obtained all the sufficient audit evidence and appropriate audit evidence. If he feels that based on the audit evidence obtained, the financial statement as a whole are not free from material misstatements, then, or he is unable to obtain sufficient audit evidence to conclude that the financial statements as a whole are free from material. So first, he concludes that nay, they are not free from material statements, or he is unable to conclude. Then it is called a modification, and he has to modify. When he has to modify, now, if he feels that no, now clearly I'm jumping, and the modification that I'm coming to over here is that if the financial statements are pervasive and the impact, or rather in the professional judgment, and the matter is such that the matter is pervasive and it is material, then the financial statements have to be given an adverse opinion. Then in such matters, adverse opinion has to be given. Or if the matter is such that it is pervasive also and it is material also, but he has not obtained sufficient, then you give a disclaimer of an opinion. But if the matter is not pervasive but is material, then you give an qualified opinion as far as financial statements are concerned. Material but not pervasive. Here, material and pervasive, then audit report. So here, rather than getting into the text of the matter, I would just, whenever I give or teach, or whenever I have, the way I have understood it, and also I give, whenever I give lectures on this particular matter, if somebody asks me how am I, and I say, yes, I'm fine and I'm good and I'm doing good. So that is a clean audit report. But if somebody asks me, how are you? Then I say, okay, I'm fine, but I've got a little bit of a headache. Then that is a qualified opinion. So therefore, that's fine. But somebody says, how are you? And I'm not well at all because I have got serious diseases. Then that's an adverse qualification. So therefore, this is how you can correlate to your audit reports. But imagine a situation, friends, here. Sometimes we as auditors, and I'm not pointing a finger at any one of you, but it is a tendency for the auditors to protect our client. Whether they protect us or no, it's a separate thing. But what we do is dekhte hain client ko kaise help kar sakte hain. So therefore, sometimes even the matter is so pervasive and it is so material, then also you like to go in for a qualification of opinion. The matter is that suppose if somebody asks me, how are you, sir? And I say, I am first class, but my head is paining, but my one kidney has failed, but my one lung has failed, my half brain is damaged. Then can I say that I am well? No, then I cannot say that I am well at all. So then it is an adverse opinion that the financial statements do not present a true and fair view. So friends, keep this and keep this logic in mind, and then you decide. And also at the same time, friends, I've also seen, sometimes what happens is that, sometimes for small matters, company has, given an EOM, or auditor has given an, qualified opinion that the management has not collected dues on time. So, but you have to be descriptive. If you are giving, friends, you keep one thing in mind, that if you are giving a qualified opinion, then you have to give reasons, quantify that why you are giving. So therefore, friends, be careful before you get into, I'm not saying that don't give a qualified or a modified opinion, but you need to be little bit careful. And, on whenever you give a qualified opinion. So we need to understand, the matter should be pervasive, and, the finance, maybe the company has not complied with the financial statement, and not complied with the financial statement means you also have to see that, yes, okay, now non-compliance of financial statements not only is on the recognition and measurement criteria, but also on the disclosure. Some, say for example, AS19, they don't disclose, or related party is recognized properly, but not disclosed properly. Then AS22, okay, deferred tax accounting kiya, but disclosed nahi kiya. So then is the matter pervasive? Is the matter material? Then you decide that, okay, whether you want to give, does not give a true and fair view, or you will give, it gives a true and fair view, but subject to this one particular matter, it does not give a true and fair view. So this is what matter we have to see. If it is, say, I'm not, it all depends on circumstances of the case. I cannot give example as right now that in all this situation, it will a solution that fits for all. But usually a qualified opinion, usually in, my experience says that if you have, say, non-complied with any of the accounting standards, or you have, I've given examples over here, that non-provision of bad debts, that we know that these are bad debts, this money is not coming, and the management has not provided for this bad debts, or there is a known liability and the company intentionally has not provided for this known liability, then it could be a provision. So these are the, examples of that. So therefore, where is the placing of this basis for qualified opinion? It just comes immediately below the opinion. So it comes before the CAM also. It comes before the material uncertainty paragraph also. It comes before EOM also, because where your basis of qualified opinion immediately comes after your your opinion paragraph, qualified opinion. Again, there are, institute has given these formats, so you follow that wherever you require to be done. Then these are case studies. Since we don't have time, I leave it to you. I will share the presentation that, okay, these are the case studies, 1 and 2 different type of situations where there is material uncertainty, but it has been disclosed by the fact is disclosed by the management. And in the second thing, it is not disclosed. Then in the first case, you will give a qualified opinion that, yes, in our opinion, except for the incomplete disclosure of the financial information regarding which is described in our basis of qualified opinion, the financial statements give a true and fair view. That is what is the qualified. But adverse is that since there is no disclosure made only, then in our opinion, because of the omission of the information mentioned in the basis of our adverse opinion paragraph and mentioned so and so, the financial statements do not give the relevant information and do not give a true and fair view. So this is the which I will share with you. So this is the how you will draft a qualified or a qualified or a adverse opinion. And whenever even the Companies Act said that whenever you are doing that, you'll have to give reasons and try to qualify it also. Then this is the draft of a disclaimer opinion, and because of we were engaged for so and so, and because of these reasons, we are unable to have any opinion, or we are unable to express any opinion on the financial statements, etc., etc. So this is draft of that. So this is 705. So this is what I have kept. So here the standard also says that this is just the requirement. These are the technical requirements, that you amend the heading basis of opinion to amend it to basis of qualified or disclaimer adverse opinion. So this is and within the section also try to include a description of the matter. Just don't say that, you have to give the description of the matter. And then matters of material misstatement on the financial statement, specify the amount, include description and quantify of the financial effect on the misstatement unless it is impracticable to do that. And the narration disclosure include in the basis of opinion on the explanation how the disclosures were misstated. So that is how you have to give that. So again, this is what I have covered, but this is modified opinion where you have to give. So it also said that before modifying an opinion, it is the responsibility of the auditor to discuss this non-disclosure with those charged with governance, and if they are there, they should make that change and they should disclose that. But if they are not giving, then the auditor can only should disclaim his opinion only and it should include that particular disclosure in his audit report. Then emphasis of matter and other opinion. Friends, here it is important that we need to understand the difference between emphasis of matter and the other opinion. An emphasis of matter in according to the standard has to be given where the auditor, you know, uh, in his judgment, he feels, that that particular information which is referred in the financial statements or which are actually disclosed by the management in the financial statements is important enough, and that he wants to draw the special attention of the user to that. Then the emphasis of matter has to be given. Say, for example, if as on 31st March 22, nothing has happened, but in the month of April or May, there has been a major fire, then uh, it's not an adjusting event. From the management will not do any impact of that, but they will refer that post the year end there has been a major fire where 80% of the stock or major damage has happened. Then this particular matter, the auditor would like to bring it to the attention of the financial state, I mean to the user. Then he will give that emphasis of matter paragraph. But also emphasis of matter paragraph is not a qualification, so it does not give any a pervasive or a material impact on the financial statement. Say, for example, now company needs a whole-time company secretary, but it does not have a company secretary. Then does not it give a, is it a material misstatement? No, it's not a material misstatement. The financial statements continue to give a true and fair view, but this is non-compliance of other provisions. So therefore, these type of matters, in my view, would be required into a an emphasis of matter. Plus, there is certain amount of a long contingent liability with the tax authority or pending case or something like that, which the management has disclosed it as a contingent liability. Then, as an auditor, if you want to bring special attention or you believe in your judgment that that additional information or that additional communication is important to draw the attention of the users of the financial statements, then you give an EOM paragraph. So that these are type of examples of emphasis of matter. And other matter paragraphs are you suo moto would like to bring some information on the table to the users, but which the management has not given in the financial statement. Say, for example, you have done the audit and a consolidated audit, and you have not audited the subsidiary, and the subsidiary audit has been done by another auditor. Then you need to give that particular other matter that, okay, I am giving my opinion on the consolidated financial statement, but in that other matter, these consolidated financial statements also include financial statements of two subsidiaries having this balance sheet side, having this cash flow, having this profit and loss, this thing, which is not audited by me, but it is audited by other third auditor. And I have, taken into account his audit report while framing my opinions. These are other meta paragraphs. So these are examples of other meta paragraphs. So this is what, it's just one more matter also the standard always say is that you have to keep in mind that whenever you give emphasis of matter or other matter paragraph, you conclude there by saying that your opinion is not modified in respect to the other, I mean these matters which I emphasize. So therefore that line which I showed you in the audit report needs to come, that is where it comes. So therefore that is where it is. Other matter paragraphs I have left it at. So these are just descriptive of other matter come. This again, I've shown you these are illustrative formats, what the institute has come out with. But therefore, I have already actually covered the live audit reports which I've showed you. So all these are particularly, included. It's already, part of that statement which I have earlier covered. So this is the format of the audit report. Then friends, 701, I will just briefly talk about because 701 is key audit matters, which in the judgment, of course, this became applicable from April 18 and all auditors, I mean, is mandatory for auditors of listed companies to give. For other unlisted companies, it is mandatory, it is optional. It's optional, it's not mandatory. And only if the auditor feels that he needs to give additional information or, auditor decides to communicate on CAM or key audit matters voluntarily, then he has to do so. Then, or otherwise, those charged with governance have requested him and he has agreed to that engagement, then he needs to give that key audit matter. So friends, here, don't get excited, that key audit matters, hum to denge, hum to dal denge. So it's not a replacement to a qualification. It is not a replacement to an emphasis of matter. It is not a replacement of, uncertain material uncertainty of going concern. But in very, whenever you are giving any CAM or determining area of any CAM, you need to keep this, highlight that, okay, this is the broad guidance which gives that how do you identify CAM. First and foremost thing, I think that, the last point is most important, that if, there has been a major event during the year or some major transaction which has happened or some, important strategic event that has taken place during the year of your audit, and that has impacted your audit, then you consider that as a CAM. Maybe, for example, some merger has taken place, then how did you audit that merger, etc. Because again, I told you, don't get excited or overexcited to give a CAM, because along with CAM, you also have to give that how an auditor has dealt with that. So you are pinning down your responsibility on that. You are jotting it down that, yes, this is my responsibility. This was the key audit matter and this is how I've addressed. Tomorrow client to khush hoga ki chalo, you are mentioning more and more CAM. That means the comfort is there. You have dealt with that. You have looked at it. So there's no failure. So if anything else happens, this can be a double-edged sword and work against us also. So that is first important and easy matter. Second matter is that some matter is very material, and you have relied as an auditor on the judgment of the management, and those are these are significant particular matters for an account, for example, complex accounting estimates. Say, for example, revenue is always recognized on percentage completion or over a period. So therefore, how the management recognizes revenue. So for example, in software companies and all that, revenue recognition always becomes one of the important significant areas. Then also maybe some, fast food chains are there which have got so many restaurants which take so many places on rental, and then whether their fixed assets are there, so how they are, amortizing the fixed asset. That estimate is that okay, once in 3 years, or you write it off these, improvements over a period of 3 years, or some other judgment on depreciation, etc. Whenever these are material items, and the auditors in his judgment feels that these are significant management judgments or estimate, then he has to bring it up, that way. So not necessarily that all depreciation would be there, but maybe revenue could be one of the items. Second thing is that, the first thing which I've told you is that certain areas which the auditor feels that, these are high potential areas or risky areas where material misstatements or significant risk can escape. Then, and he has how he has dealt with, and how he has addressed this, and this requires special attention, special additional audit procedures, then they become CAM. Say, for example, in banks, the accounting never takes place. Everything is automated. Interest calculation, the interest charge, interest income, NPA recognition, provisioning, etc. Everything is automated. So there is heavy reliance on the core banking system, or there is heavy dependence upon the accounting system. So the auditor needs to understand how he has audited, whether the system is working adequately or no, whether there are manual intervention, whether the system is breaking down, or whether how competent that system, how accurate the system is. So this is where, so maybe in banks or NBFCs, audit of key, the core banking solution could become part of CAM, etc., etc. So these are certain highlights, these are always, consideration that an auditor should keep in mind to identify CAM. And also the guidance is that how do you give guide, I mean, whenever you identify CAM, also you first and foremost thing, those matters what should be highlighted as CAM should be part of your initial audit consideration matters, which an auditor feels that in his these were most significant. So how do you zero down to those matters? First and foremost, you have all the matters that you have communicated with the, to those charged with governance or those with the management in smaller companies. You have identified all these matters. So it cannot be out of the blue that this point is, if it has to be from the matters, that all the matters collectively from your audit process that you have collected. Then those matters you have escalated it, and it requires special attention or a significant special audit procedure that you have followed, or you think in as an auditor that these require special attention. So those are there. And so you zero down from say 20 issues that you have discussed with those charged with governance, then you zero down to 5 or 6 issues which you feel were significant. Then from there, most significant, you draw down and you find out 2 or 3 areas. So I'm not giving a justification that CAM could be only 2 or 3. You could have more CAMs also, but these could be key audit matters. So this is the matrix that gives you guidance on how to consider on 701 key audit matters. And since it is listed company, applicable to listed companies, and it's a particular different topic by itself, so I'm not taking that much in detail. And lastly, finally, I would like to end with SA 720, which again will just take me a couple of minutes, that it is the responsibility this, on other information that gets disclosed along with the financial statement. This is also a new requirement and onerous responsibility of the auditor. Say, for example, certain financial information gets disclosed in the director's report. It gets disclosed in the management analysis and this, MD&A. So in these particular things in annual report, these particular items get disclosed, and it has got reference or linkage. So there should be consistency. So friends, in listed company, what happens is that yes, all this information in the director's report, etc., comes to the auditor in draft form, because the director's report either gets adopted at the same date or in the next date, etc. But in private limited companies, what happens is that everything gets adopted on the same date. And if the auditor said that this particular information was not provided to me, therefore I have not commented on that, that's a wrong statement. So whenever you are giving comment under 720, please speak to the company secretary, please speak to the management that when are you going to adopt your director's report. If you are going to adopt it on the same day, please give me a draft, and whatever information you are adopting on that or you are giving in that, please share it with me, so I will give an additional disclosure. So therefore 720, as I told you, not only applicable to listed companies, but applicable to all companies, all entities. So therefore, even for private companies, keep in mind. And if you need to disclose that whether you have seen the information, and if you have anything to report on that, or you have not seen the information, and when you see the information you have anything to report, you will report. I think so this is the gist of 720. This is what it is. And summary, okay, this was, sorry, going concern, this is what I wanted to cover, but I have already covered this when I did that, when I covered SA 570, that when you need to give a disclaimer, or when you give need to give an emphasis of matter or adverse opinion. This is a flowchart which I have given. These are some questions which I will leave it to you, and answers also I have given. FRRB observations also, commonly found mistakes, though this particular have not been covered, but whenever I have covered each particular point, at that time I have tried to correlate with this, that what were the mistakes that were given. So therefore, this particular thing is part of that FRRB observation. And I think so with that, I conclude my presentation for today. If there is, if there are any questions, I'll be happy to take it. But I would just like to share my live slide over there, that, just don't behave like that. Somebody asked the trainee that why are you crossing the road? And that trainee said that I am crossing the road because my senior told me that this was done last year, so you do it this year. Don't be such a blind, just see whether it is applicable or no. And if it is applicable, you need to amend your audit procedures, modify your audit procedures to take care of the changes. Thank you.
Thank you, sir. Thank you so much. Can you hear me, sir?
Yes, sir.
Thank you so much, sir, for such a detailed and wonderful deliberation covering 700, 701, 56, and 20, as well as other detailed explanation. It was in a very, very informative and lucid manner. Thanks a lot on behalf of WSB. And continuously, you have spoken for around 1 hour and 45 minutes, sir. And very good. The heartiest thanks to you, sir.
Thank
So
you.
I have received 2, 3 queries, sir. If you
Yes.
permit, may I ask those queries, sir?
Yes, please.
Sir, such query you have already discussed regarding the format of the audit report. one member is asking when it is commonly prevalent. So what is the main change in the audit report and why these changes were made?
See, first and foremost thing, I told you the changes initially, if you actually first and foremost thing, if you see the audit report in India is the longest. I have never seen an audit report in India, which is because it covers Caro, etc., etc. Caro and all that are not there in the international market. Now, when internationally the standards were upgraded, even in India that project was carried on, and India had to be at par with other developed countries. So therefore Indian standards on auditing also were upgraded. If you see prior to 2018, the opinion paragraph was coming at the down. So all these changes were made to bring about, as I told you, consistency in reporting. So therefore across the universe there is, the reporting is stable, is consistent, is comparable, and it is more meaningful and relevant. So that was the main requirement why these changes were carried out. And certain changes were carried out, say for example, now as I told you, for Rule 11, etc., because government amended the rule, so therefore that change was required.
Yes. So in case the auditee has collected advances to the extent of 4.5 crores, but has not paid GST on these advances, Caro is applicable or not applicable to this company as per the existing turnover?
Caro is applicable or not applicable?
Hmm.
What is the question? That GST is not paid on the advances?
Member has mentioned the half question, I hope. He is
Huh.
saying in case, in one of the case of the auditee has collected advances to the extent of 4.5 crores, but has not paid GST on these advances. Caro is not applicable to this company as per the existing turnover. So what is your opinion, sir?
See, in my opinion, is that does it give a true and fair view? Yes or no? If you have collected advance and not paid GST, उसमें true and fair view impact नहीं होता है. So you may not, qualify your audit report, but it is a non-compliance of some other law. So if you want to bring to the attention of the if you want to bring the attention to the shareholders or the readers of the financial statement, first and foremost thing, you have to, if you believe that there is a non-compliance of law, you have to persuade the client that you give that disclosure that because of this reason, GST has not been paid and we will be making the payment of GST as and when these circumstances happen. And if you feel the amount is material looking at the full overall financial statements, then you would consider bringing about in the emphasis of matter paragraph that this is a particular thing, this fact, and I'm giving reference to this. If that person has not disclosed and you feel that this is a non-compare of law, then you might give an adverse impact that because this information is not disclosed in the financial statements, I'm giving an adverse opinion. So this could be your 2 or 3 options which are available.
Yes. So one query is relating to the UDIN. As per the amendments in the Schedule 3, the figures need to be rounded off. While generating UDIN, which value to be mentioned? Whether rounded off value or actual value?
There is again, people have asked me that question. If you are signing the financial statements in rounding off, you could give a rounded off value also in thousands, lakhs, or whatever that is.
And what about in case of UDIN, sir? While generating UDIN, which value to be mentioned?
No, in UDIN only you could give rounded off so that it matches with the financial statements.
So another question, GST liability of rupees 6 crore due to the wrong availment of GST input and GST liabilities limited company audit as on 31st March 2022 and financial year 21-22. What disclosure and how to finalize under Caro?
Okay, so it was wrong credit that they have taken, and in Caro the requirement only is to mention whether undisputed dues for more than 6 months has to be reported or whether there is any dispute. So if there is no dispute, then under Caro it will not come. And if there is any undisputed liability not paid for more than 6 months, then it has to be reported there. Then maybe you could be right if in that Caro, if you mention that, okay, this was, a wrong credit which has been taken, but your financial statements will not support that. You will mention that, yes, there is an undisputed liability which the company has not paid, but the financial statements will not show it as a dispute. So first you get that corrected and then mention it. Or in the Caro report, you give that so and so fact is there and there is a wrong credit which has been taken, which the company has not paid. Therefore, it could be a non-disputed liability.
Yes, sir. Sir, is key audit matters as per SA 701 applicable to private companies also, which
No,
is
it is not
subsidiary of the
applicable.
listed company?
Only it is applicable to listed companies, or otherwise in two circumstances, either auditor suo motu on his own wants to give a key audit matter, or the management has asked the auditor and the auditor has agreed that, okay, in his audit report, he will give a CAM. Then only, otherwise no.
Whether it is a subsidiary of the listed company also.
Yes, even if it's a subsidiary of the listed company, it's not required.
Last question. Member is saying, I have seen a few audit reports where an EOM is given to the following effect. We draw the attention to note no regarding balance shown under the claims recoverable, trade receivable, advances to contractor, trade payable, and sundry deposits, which are subject to confirmation and reconciliation and consequent adjustments. Member is saying, I have two issues to the aforesaid. Number one, ideally, such a note should not appear in the financial statements, and if it does, we have to very sure that whether it calls for modifying the audit report, or number two, not sure whether an EOM will suffice in such a case, whether the amendment itself is saying that the balances are subject to reconciliation or confirmation.
No, I agree, totally agree, because this disclosure need not come. And actually, FRRB also has taken and made this observation that, yes, you cannot say that balance confirmation, balances are subject to confirmations. You as an audit, first, the management has to get these balance reconciled. If there is a discomfort, additional audit has that 550 under balance confirmation, auditor has to carry out these additional audit practices, alternative practices, and get this confirmation. If they do not get the comfort, and they do not get or they get some discomfort and it is pervasive and material enough, then the auditor is right in qualifying. Otherwise, just because balances are there and it's not reconciled, if there is nothing to reasons to believe that it could be pervasive, then no need for qualification and no need for EAM also.
Right. So now we come to an end. We have justified with your presentation, sir, and covered almost all the questions and covered all the requirements of essays for finalizing the statutory
Yes,
audit
आपको
report.
पूछना था, are participants there? Because what has happened, no, I have forgotten, one qualified audit report is there, which I just wanted to show. Are there participants there or they are not there? Have they left? अगर participants है तो मैं 1 minute वो दिखा देता हूँ, है?
हाँ जी, दिखाइए सर. Still 1100 and more than 1150 members are there.
Okay, 1 minute. Okay. One minute. I'll open that. Yeah. Can you see the screen?
Yes, sir. Yes, sir.
See, this is audit report where it is a qualified audit report. So it says audit report, it says qualified opinion. It gives that it is a qualified opinion. Then in his opinion paragraph also, so here he explains the financial statements, name of the company and the finance. This is again all available on public domain only. It's a listed company, so it's nothing that anything I'm showing which is not confidential. So in the opinion, the best of the information and explanation provided given to us, except for the effect of matters described in the basis of our qualified opinion, and the aforesaid matter gives us true and fair view. So here that particular thing is there. Then basis of opinion ke badle he has modified for basis for qualified opinion. Then he has given reference note so and so. Because of this note so and so, there is a qualification. And so this is his main, these two important things, qualified opinion. Then here, this is a modification here. And as I told you in 143.3, where he has to mention that he will have to mention over here. here, except for the matters described in the basis of our qualified opinion paragraph in the proper books of accounts as required by law have been kept as so far as appears. So here it says, except for matters described in qualified opinion. And again, except for the possible impact, section 133 is complied. Otherwise, you cannot say that 133 accounting standards have been applied. And last is that matter described in basis for qualified opinion above, in our opinion, may have an adverse impact on the functioning of the company. So whenever you're giving an adverse opinion, keep this in mind, that changes not only in that opinion paragraph will come, but besides the two changes here, three changes also will come. I think so. This is what I just forgot about. Acha hua yaad aaya, so I can share it for the benefit of all the members.
Yes. Thank you so much, sir.
Thank
Thank you
you.
so much for spending your valuable time and acceding to our request. Thank you so much, sir. On behalf of WSB of ICI, I extend my heartiest thanks to you. Thank you so much.
Sir. Thank you.